Hey everyone, welcome back. Today we will wrap up the three-part series on the financial statements and how I analyze them. If you haven't seen the first two parts, in those videos I covered the income statement, and that video should pop up somewhere on the screen now, followed by the balance sheet, and that video should pop up now. So if you want to go watch either of those first, please feel free to do so. In this last video, we are going to talk about the statement of cash flows. So let's hop into it. I'll pull up Apple's most recent 10K. I've covered how to access this in part 1 of the series, but let's jump right into section 8 for the financial statements and get into the statement of cash flows. Really quick, let me explain what the statement of cash flows is showing. While this may be very clear if you are experienced in accounting or work in finance, but high level, what the statement is doing is reconciling all cash that comes in and out of the business compared to the income statement and balance sheet during a set period of time. The reason we have to do this is because we report on an accrual basis and not a cash basis. I covered the difference of this in part 1 of this series, but a quick recap, if we look at Apple, we will see net income was $96.9 billion. The thing about this is not all of that is accounted for in cash. Some of the revenue behind that may have not been collected yet. Some of the expenses may have not been paid yet. So on the statement of cash flows, we reconcile these differences to understand all the cash generated from operations. There are actually 2 additional sections as well for financing and investments, which would not flow through the income statement, but would impact the balance sheet. So now back to the statement of cash flows for Apple. We'll see there are 3 main sections. We have operating activities, investing activities, and financing activities. These 3 categories will always be the same regardless of what company you are analyzing. This is not unique to Apple, but a standard reporting structure based off GAAP. Let's look at the 3 sections at a super high level before jumping in. So the first section, operating activities, will reconcile all parts of the business related to operating it. So anything that flows through the income statement, such as research and development, selling, general and administrative, will actually be reconciled here. Now, it won't be explicitly be called out as SG&A or R&D, but for example, share-based compensation in both the SG&A and R&D numbers reported by Apple on the income statement. So some of these expenses reported on the income statement don't actually cost Apple any cash. Share-based compensation is a non-cash expense, for example. So here we will see them starting with net income, then adding back share-based compensation, as it is artificially lowering their net income on a cash basis. A quick side note, share-based compensation does have an actual cost to shareholders as it dilutes you. Usually companies will perform buybacks to offset this expense, but when that is done, then cash is actually flowing out of the business still. And if they don't buy it back, then you're diluting your percentage ownership. And then you'll also have current assets and current liability accounts that are adjusted as well, like accounts receivable and accounts payable. And same with inventory, which would all actually flow through the income statement through one of those expense lines. So second section will be investing activities, and this is exactly what it sounds like. Any investments the company is making. This could be things like property, plant, and equipment, and also marketable securities, which are also known as stocks and bonds. Then lastly, we will see financing activities, and this is any activity the company is doing that changes the capital structure of the firm. Think of this as the debt to equity ratio of the company. Dividends also flow through this section. So for Apple, we'll actually see payments of dividends reported, along with proceeds from debt, repayments of debt, repurchases of shares, things of that nature. So now let's jump into each section, and I'll explain in a little more detail what I'm looking for when I look through a cash flow statement, when I'm working to build out a financial model. Starting with the operating activities. This will always start with net income, and then from here they will reconcile. The first big thing will be depreciation and amortization. This number I always pull down from my model. I will use this and look at it as a percentage of CapEx. I like to see this be around 85% as a percentage of CapEx. I will touch on shortly where you actually pull down the CapEx number to calculate this ratio. But back to depreciation, the best way to think about it is everything Apple purchases that has a multi-year useful life, they will only recognize a portion of that expense each year. If Apple purchases a new machine, for example, they don't want to recognize 100% of that expense in the first year when they purchase it if it's going to be used for the next decade, but rather they will spread out the expense over the multiple years or the useful life of the asset. The spread out of this cost is depreciation. So in reality, Apple has actually already paid out for the machine, but from a financial perspective, will only recognize a portion of that expense each year. And it's going to be based off a schedule defined by GAAP. Now, back to the ratio of depreciation to CapEx. If depreciation is greater than 100% of CapEx, this actually kind of signals they're investing less today than they did in the past. And this could indicate that they're actually slowing down investments into the future. I don't like seeing this, as it is a way to shore up short-term cash flows at the cost of long-term growth. You have to be continuously investing in the business for it to continue growing, and CapEx is usually the best indicator of what is being invested to grow the business. So if depreciation starts to outpace CapEx, in my mind, that's a bad sign. Another thing to look out for here is if depreciation is a very low percentage of CapEx. This means that they are heavily investing into the business compared to historical levels, which if you like management and believe in their vision, then this could be a good sign, or a bad sign if you don't like them. And there can be times where things get a little out of skew on depreciation, as companies will accelerate depreciation from time to time. But if that happens, there should be a footnote somewhere in the 10K talking about this. And once again, when we get to the investing section, I will talk about where we pull the CapEx number for calculating that ratio. So after depreciation, we glance at share-based compensation. In a tech company, I expect this to be a material amount, as they tend to pay their employees this way. If you're looking at a low margin manufacturing company, I want to see a very low level or no level of share-based compensation. I will usually look at this as a percentage of revenue. Tech companies tend to be on the higher side, around 10 to 20% of revenue. Apple is actually on the low end here, which is nice to see, but they also have a lower employee count compared to some of the other FAANG counterparts, or at least corporate employees. So it's a significant amount. If it is a significant amount, I can layer it into my models, but largely I ignore it. I look at it more as an indicator of how management is rewarding their employees and themselves. And if it's a low, poorly performing company, I don't want to see large amounts of share-based compensation. After this, I largely glance over the remainder of the operating activities subsection. We'll reconcile the operating assets and liabilities through our calculation of working capital that I covered in part 2. So this section isn't as relevant, but quickly a note here is this subsection is reconciling operating assets and liabilities, which is largely the current assets and current liabilities used in working capital. The reason these either generate or use cash is because of payment terms for accounts receivable and accounts payable, such that you may record the expense but have 90 days to pay it. And again, this is because of the accrual accounting from GAAP. The other big thing you will usually see here is inventories. If your inventory is growing, this is using cash. You are having to pay to manufacture those goods and services. While if inventories are decreasing, this is generating cash, as you are actually selling inventory faster than you are accumulating it. One of the big things to take note of though on this section is the total cash generated from operating activities, as this can be a good proxy for their free cash flow. You can sometimes see companies that have net loss or a very low net income, and then they actually have a pretty high operating cash flow, and vice versa, where maybe they have a high net income but awful cash flows. So it's good to take a look at this, but for our sake, depreciation and stock-based compensation are the main things we're looking to pull out from this section for building our models. At the end of this video, I'll actually touch on how I look at all 3 sections of the cash flow statement in conjunction to understand a bit more of how the business is performing. Now on to investing activities. The main thing I care about is the acquisitions of property, plant, and equipment. This is what we will call CapEx, and we will use this to calculate our ratio of depreciation to CapEx. Some companies will actually have a separate CapEx schedule on their 10K, but it's not consistent. So this is the best place to pull the CapEx number. One thing to note is it will be shown as a negative number, as this is cash flowing out. When I calculate my ratio for depreciation as a percentage of CapEx, I will use the absolute values here. After CapEx, it's good to look at the investment activity. It's not always super informative, as they are always buying and selling securities, and sometimes they may buy more than they sell and vice versa. So it's hard to draw any real conclusions here just from looking at this, but it is interesting to see. And if you see them sell a lot of securities and not purchase anything else, they may be gearing up for a large purchase, or They may even be relying on selling their investment portfolio to support operation. So the main item we want to look at still is the acquisition of property, plant, and equipment, which is our CapEx number. I will usually look at this as a percentage of revenue also. So when I build my model, this gives us a good indicator of how things are changing and the investment levels in the business. Companies that are younger should have a higher percentage of CapEx to revenue, and more mature firms can hover as low as 2 to 3% if it's not super capital intensive. But a good benchmark is usually high single digits, something 7 to 10%. When building a model, it's always good to look at these same ratios for a handful of firms and competitors in the same industry, so you can tell if the company you're looking at is under or overspending relative to their competitors. One thing to note though is if you see CapEx as a percentage of revenue go from 15% to 5% from one year to the other, this could actually show that they've stopped spending on the future and could be, once again, a bad sign that they are trying to shore up cash flow in the short term and expense for long-term growth. Lastly, we have financing activities. The main thing I like to see here is just any new debt issuance or stock issuance to raise money. If you see cash increase a lot on the balance sheet, but it's done by the issuance of stock, that may not be the best as a shareholder, as you could potentially be being diluted. AMC has done this a lot to their shareholders recently. The alternative though is issuing debt, and if you have poor cash flows and they're not super strong, then you may not actually be able to pay back the debt. You can track the repurchase of shares here, also here, which can be interesting, but there should also be a schedule on the 10K that should break this out as well. Overall, this is just good to see if they are paying off debt, issuing debt, buying back shares, or issuing them. It's good for understanding how the capital structure is changing within the firm, but will not be plugged into our model. Now, the big thing to analyze from all three sections is how they are funding each other. For example, with Apple here, we can see that operations are producing a lot of the cash, actually, in the amount of $110 billion. They are taking this cash and using it in financing activities, more specifically to buy back shares and issue dividends. Their CapEx and investments are actually about neutral, so no overall impact to the business from that section. You could also see the opposite situation here a lot of times for firms that struggle. Their operations could actually end up losing cash while their financing activities are generating cash. In this case, the business is unprofitable, and to support this, they are issuing debt or equity to keep the company afloat. So it's really important to look at the holistic picture and understand what is generating the cash and what is using the cash. So it's always good to understand what's going on holistically. Are they generating cash from operations that they are then putting into investments, aka basically hoarding the cash for later days? Are they generating cash and then paying it out through financing activities? Are they losing money on operations and having to actually fund the business either through selling off investments or through issuing or selling shares of stock or debt? So it's really good to understand at a high level how the company is operating in total. Anyways, that's all I had for this video. Let me know if you have any questions or comments below, and and one note is I am going to pull together a final video where we go back through all three statements and build a model for Apple to kind of wrap up this series. But anyways, thanks so much for watching and have a good day.